Everything I just delineated is unfolding, and there's data to support it, not just an inverted treasury yield curve, which is intriguing. Well, Tuesday 10 is the primary sector where it's inverted, but even more profoundly in the euro-dollar futures curve. Yes, I label the treasury yield curve a short-term gamble on a long-term rate. The euro-dollar futures curve is a long-term gamble on a short-term rate because the euro-dollar future is akin to betting on what an overnight rate will be 2 years from now, for instance. All right, long-term gamble on a short-term rate, and it's inverted, and it shouldn't be. It does occur, but it shouldn't occur. Yield curves ought to have an upward slope simply due to time, value of money, and uncertainty, etc. If I lend for an extended period or make a more forward bet, I should receive a higher rate. How is it that those wagering on overnight rates a year or 2 years from now assume that rates will be lower? That shouldn't be the case. The only rationale for that is that we're going into a recession. It will get substantially worse. Nevertheless, I return to a highly significant differentiation between a recession, even a severe one, and a financial crisis because they're distinct phenomena. They can converge, but for instance, in 1998, there was a severe financial crisis with long-term capital management, which I negotiated a bailout for, but there was no recession. Conversely, in 1994, the tequila crisis and the bond market massacre occurred, constituting financial crises without a concurrent recession. In 1990, we experienced a relatively mild recession without a financial panic then. Now, 2020 was intriguing. I'm not sure what to term it. Technically a recession, the economy contracted by 31% annually in 2 quarters, but it was predominantly over 2 months. It happened in March and April, spanning 2 quarters and leading to negative figures in both, dropping by 31% annually in 2 months, and then rebounding by 35% by the 3rd quarter. That was extraordinary. So perhaps that's technically a recession. It's what transpires when the economy is shut down. Still, there was no financial panic. The stock market declined, but the banks didn't collapse. Nobody was queuing up to withdraw funds from Citibank, etc. Recessions can occur devoid of panics. Financial panics can occur without recessions. For example, October 19, 1987, the Dow fell 22% in 1 day without an accompanying recession. However, sometimes they do coincide. In 2008, both transpired. We faced a bona fide financial panic. Everyone is familiar with Bear Stearns, Fannie Mae, Freddie Mac, Lehman AIG. But I can tell you, and I've conversed with numerous individuals, Morgan Stanley was on the brink, and then Goldman would likely have followed, probably Citibank, and perhaps JP Morgan would have been the last. The economy plummeted, and the stock market declined by well over 50%, possibly 60%. That was an instance of both. My apprehension is that we might be heading into both, considering everything I described about the underlying framework of the financial system, acute dollar scarcity, the rush for collateral, which leads to deleveraging as I can't obtain the collateral. I need to dial down balance sheet leveraging, etc. These are the early indicators of a global financial panic and a probable recession. We could potentially witness a severe recession and a global liquidity crisis, 2 separate occurrences, but they could converge. Gotta acknowledge a bit of recognition to Robert Shiller. He penned a remarkable book entitled Narrative Economics. Now, narrative is merely a sophisticated term for a story. It implies a story that many people buy into, but in reality, it's a story that people believe. This dates back to the eminent sociologist of the 20th century, Robert K. Merton. There's no Nobel Prize in sociology, but if there were, Merton would have secured it. He's the one who coined the phrase the self-fulfilling prophecy. The archetypal example is someone getting nervous in the morning and pulling out all their money from the bank, and someone else sees that and follows suit. Then everyone is in a rush, and the bank closes by day end. This occurred because a story circulated. People believed it. People acted on it. That's the key. Do you act based on the story? You can turn the thing you're worried about into reality, even though it wasn't true when the story began. Narratives can be accurate, but they can be false. A completely unfounded narrative can be incredibly influential if enough people buy into it. The Fed pivot is a narrative, and it proceeds like this. Inflation takes everyone by surprise in late 2021, and Jay Powell announces the retirement of the term transitory, and then inflation surges, the stock market plummets, and it's still declining. But after the Fed raises rates and the yield curve inverts, the narrative shifts to, well, wait, the yield curve inversion suggests that rates will be lower months from now, inflation is cooling off a bit, and they'll have to cut rates. That was the pivot. And rate cuts are beneficial for stocks. So buy stocks. Then we witness this rally. The stock markets reclaim much of the lost ground, all predicated on the Fed pivot narrative, which I never bought into. I didn't want to confront an advancing train. I wasn't going to short the SAMP. I did not accept the narrative for two reasons. Firstly, inflation reduced from 9. That's commendable, but aiming for 2, there's a considerable way to go. How much demand destruction? How many rate hikes? How much do you need to do to genuinely stifle the economy to bring inflation down to 2? The answer is a lot. And explain to me why that's good for stocks. It's not. But secondly, and this is a bit more sophisticated analytically, merely because the yield curves imply that market pros believe rates will be lower, doesn't guarantee that the Fed will cut. That's the message. But it doesn't assure the Fed will heed the message. How often does the Fed get things right? Never. The buy the dips crowd is still present. I'll say the talking heads, I suppose I'm one. But the enthusiastic supporters on Wall Street have never vanished. Wall Street always wants to vend you something. There are individuals who believe the Fed knows what they're doing, but the fundamentals haven't altered. Predicting the consequences of Fed policy is tremendously difficult. However, predicting Fed policy is the easiest task in the world because they declare their intentions, but the tricky part is determining what will occur as a result. The Fed is mulling over a potential rough landing, but not too turbulent. I'm considering more of a plane crash. Not to delve too deeply into jargon, but sometimes I can't resist. There's a concept. It's not overly complicated. It's referred to as DBO1, which denotes the dollar value of 1 basis point. It signifies that if interest rates go up by 25 basis points, what's the shift in the price of securities? Rates up, prices down, rates down, prices up. That's simply bond math. But it's not consistent or linear at all levels of rates. So at higher rates, the DVO1 is lower, and at lower rates, the DVO1 is higher, meaning the impact of each basis point increase in interest rates is greater at lower levels. Therefore, elevating rates from, say, 2 to 4 has a much more detrimental effect on prices than going from 8 to 10. However, the impact on bond prices from higher rates is less than escalating from 2 to 4, where it's akin to tossing these bonds in the trash, and that plays out in the derivatives world. That's an additional factor alongside the shortage of collateral and dollar scarcity. About $1 quadrillion in notional deleveraging balance sheets and a higher DBO1, indicating that these interest rate hikes inflict more damage per basis point to bond prices when rates are at a lower level. That's definitely a close concern,